Hi, and welcome to another Mr. James Accountant tutorial. Today we will look at 2017 Paper 2, Module 2, a much requested module by most of you. We are given here a balance sheet for a partnership, Audrey, Camille, and Robert. I have read it already. If you haven't read it yet, I would suggest that you do so now on before you look at the rest of the recording. We'll look at some of the additional information. And Audrey retired on 31st December 2015 to commence her own business. Camille Robert continued the partnership, sharing profits and losses in the ratio 2 to 1. Okay, we are asked to prepare a revaluation account and the partner's capital account of the old and the new firm. Okay, now that's a bit of a mistake there. That should be of the old and the new partnership. The firm remains the same, all assets and so on, and liabilities, but the partnership itself is what changes. Okay. It was agreed that Audrey should take over plant and machinery valued at 200,000 and one of the firm's motor cars valued at 250,000. Right, so we'll have to account for that. It was further agreed that the following adjustments should be made in the balance sheet as at 31st December 2015. Okay, so what will happen here is these adjustments would be made in what is called the revaluation account, which is what we are asked for here. It is sometimes called the revaluation adjustment account. You would see in some texts, but I simply call it the revaluation account. It's a temporary account that you open and make these adjustments and then you close it off and start the books in the new partnership. So land and buildings should be revalued at 1,800,000. Plant and machinery, excluding that taken over by Audrey, should be revalued to 400,000. The provision for bad debts should be increased by 10,000. Inventory should be revalued at 80,000. Trade creditors will be taken over by the new partnership at book value. Okay. In accordance with the terms of the partnership agreement, the total value of goodwill on 31st December 2015 was agreed at 600,000. Partners decided that goodwill shall not appear in the books of the new partnership as an asset, with the necessary adjustment being made through the partner's capital account. Pending the introduction of further capital by the continuing partners, it was agreed to leave the amount owing to Audrey on the loan account. So we are not going to do anything with the loan account. We're just going to leave that there. We're going to bring the goodwill into the partnership, share it among the old partners, the three of them, and then we're going to remove it from the books of the new partnership with just the two partners. Right, I will do the workings for it first, and the workings will take the form of journal entries because sometimes these questions ask you for journal entries. So we will sort of kill two birds with one stone. And first, we will bring goodwill into the books by debiting goodwill with the 600,000 valuation of goodwill. Then we will share that among the partners. Since all three partners were present during the development of that goodwill, each one of them should get their share. And that will be 3,000, 2,000, 1,000 in their profit sharing ratio. Next, we will remove it from the books of the new partnership by crediting goodwill and debiting the two partners that remain in their profit sharing ratio of 2 to 1. Okay, so this year will knock off with this year and it will not be in the books anymore. This year will share the goodwill um, among the partners, including the partner that's leaving, and this year total the same amount, would remove it from their capital accounts again. Notice anytime the goodwill come back into the books, if one of these two decide to leave, it will be coming back in at 600,000, 400 for Camille, 200 for Robert. Okay. Now this is something you could memorize quite easily using the formula credit old, debit new. Okay. You credit the old partners in the old profit sharing ratio, and you debit the new partners in the new profit sharing ratio in the new partnership. Okay, first we will open a new account called a revaluation account, and then we will make the following journal entries. We debit the land and building to increase it by the 300,000, and we credit revaluation with the 300,000. And then we will debit revaluation with 100,000, credit plant and machinery with 100,000 to record the loss in value of 100,000. The 10,000 for the provision for doubtful debts is a $10,000 loss on the accounts receivable. And then we have 10,000 loss on inventory again. So what we will do next is we will enter all these transactions here in the revaluation account. If the debit side is greater than the credit side in the revaluation account, you would have a loss on revaluation. If the credit side is greater than the debit side, then you have a profit on revaluation, and you will share it accordingly to the partners. So we look at now at the revaluation account, and we have the increase in the land and building credited for 300,000, and the loss in the value of the plant and machinery debited for 100,000. Provision for doubtful debt, a loss on accounts receivable 10,000. The inventory lost by 10,000, and that's the entries. If we add them up and balance this account, we will see that the credit side is greater than the debit side by 180,000. So you have $180,000 profit on revaluation, which you're going to share to the three partners in the ratio 3 to 2 to 1. So first, Audrey will get 180,000 by 3 over 6, 90,000. And Camille will get 180,000 by 2 over 6, which gives you 60,000. And Robert 180,000 by 1 over 6, which gives you 50,000. And that would balance off the account there. So in their capital account, we would see the 90,000, 60,000, and the 30,000 on the credit side of their account, representing an increase in their capital from the revaluation of assets or from the revaluation profit. We have next the partners' capital accounts in the old partnership, and ACNR stands for Audrey, Camille, and Robert. Audrey, Camille, and Robert. Their balance brought down from the balance sheet 1,500,000, 750,000, and 500,000. Their share of the goodwill 321, and the valuation profit 90,000, 60,000, and 30,000. And we're gonna give the Audrey the plant and machinery valued at 200,000 and the motor car at 250,000. Okay, and to remove the goodwill from the books, we take it out of Camille account and Robert account, and we pay off Audrey her balance. This 1500, 300, and the 90 gives us 1890. Bring it across here, minus these two, and we pay her 1440 in cash. And here will be equal to 0 carry any balance into the new partnership for her. We balance the other two partnership partners and we carry down their balance. Their balance will go into the new partnership as 610 and 430 in their partner's capital account. So the partner's capital accounts in the new partnership, we have the balance brought down 610,000 and 430,000. You don't have any other item in there. You shouldn't have any other item in there since it's a new partnership with new capitals coming forward for these two partners only. We'll look at part B next, and this is a repeat question. We would have seen this already in one of the other questions. Yes, distinguish between corporations and partnership in terms of following characteristics: owner's liability for debts of the business, transferability of ownership interest, continuity of existence. So three things, and usually when you distinguishing between things like corporations, partnerships, and cooperative societies, sole traders, and so on, you should do them under headings like this. Okay, you should get in the habit of doing it like these. Right. So we look at the differences. Partnership. Partners are liable for debts up to their private possession. That's the general thing. But you can have a limited partner who are responsible for debts only up to their capital invested. Each partnership must have at least one unlimited partner. Okay, and it is not really good to have all the partners uh, not responsible for the debts of the business. Then they could run up debts, and who is going to want to trade with them then, right? Corporations, members are liable for debt only up to their investment or shareholding. So a shareholder only liable for debts of the business up to the amount that he has invested in the company, right? If the company go bankrupt, he will only lose his investment. They cannot come after his private possession. Partnership, admission of new partners, sale of partners' interests to other partners or outsider, and retirement of partners are allowed. In corporations, shares are easily transferable by sale in public corporation. Okay, you could go to the stock exchange and sell your shares if you are a shareholder in a corporation, right? And but the partnership cannot do that. What they can do is they can admit new partners. They can sell, a partner can sell his interest to another partner or to an outsider, and retirement of partners are allowed. Three, partnership again is not continuous. The agreement continues until a partner retires, admission of a new partner, or a partner dies. Okay, so once you have partnership changes taking place, it's a new constitution, a new partnership agreement, and it's a new partnership on the whole. The firm might remain the same, but the partnership changes. Okay, corporations are continuous. Changes in ownership, changes in the shareholders does not affect the firm since it has separate legal entity status. Okay, it's a separate legal entity. Note the word entity there. Sometimes the word person is used, and it's a legal person as well, and having all the rights and privileges of a person, and it can continue forever while the shareholders keep changing. Part 4 required the following information was extracted from Audrey Cosmetics Limited for the year ended 31st December 2016. Okay, I have read this already, so I'll just leave it up to you to read this trial balance. Not the entire thing is applicable, but in order to get to know what is applicable, you have to read through this trial balance, right? And what I will go through here is this here and explain what some of the adjustments are, right? The first one we have here is the closing merchandise inventory at 31st December 2016 was valued as follows. Net realizable value 30,000, cost 25,000. Now, to know which one of these to use as your closing stock, you must know the rule in IAS 2, right? In National Accounting Standard 2, the rule is the law of cost or net realizable value, whichever is lower. In this case here, we have the cost being lower, 25,000. So our cost in our income statement for closing stock would be 25,000, right? And exercise for you here is to find out what net realizable value is. Okay, I will not be going through that in this question. Commissions owing at 31st December, so you have an accrual here, accrued expenses of 6,000, and during the year, a section of the roof of the building caved in. It cost the company to 20,000 in repairs to the roof to its original state. The cost of the repairs was included in administrative expenses. This has never occurred in the company before. Based on the company's policy, it is a material amount, okay? Because the amount is material, you can't just write it off in 1 year because it's going to benefit a number of years, right? So what you have to do is remove it from your administrative expenses in the profit and loss account and put it in an asset account in your balance sheet, right? Provide for depreciation as follows. So that you have 10% reducing balance, and then we divide that up into 85% for administrative expense and 15% selling and distribution. The mortgage was acquired on the January 1st, 2016, an interest rate of 10% per annum. Okay, so we look here and we see we have the interest paid 50 and the mortgage is 60,000, so 600,000. 10% on that should be 60,000, so we have another accrual of 10,000 to bring it up to 60,000, right? The mortgage was acquired on 1st January 2016 at a rate of 10% per annum. At the end of the year, the land and building was revalued at 2,500,000. The corporation tax is 25%. Required a statement of comprehensive income for the year to 31st December 2016 for Audrey Cosmetics according to International Financial Reporting Standard as far as the information goes. Okay, 13 months. So we will look at that and I will show you also an abbreviated form of the financial statement that is also acceptable. Coming up next. We will do all of the workings first and then we will do the income statement itself. So we have the sales at 3 million, and from that we take the return inwards and the allowances or the discounts allowed of 26,000 and 115,000, and we got 141,000, and our revenue is going to be then 2859. And what you can do is you can stop the video at any time, go back and look at these figures and see where they are coming from. Okay, I will not be still in the clock. We have the cost of sales, and we start with the stock at the 1st of January, 95,000. Then the purchases, the returns on the purchases, 180,000. The freight in is the same as the carriage inwards, and the goods available would be 1,150 less the stock at the 31st of December closing stock. We saw that was 25,000 and not the 30,000. Okay, we will get cost of sales 1,105,000. Okay, now it is acceptable to do this where all these workings would show up in your notes to the financial statements, and only this figure will show in your income statement. So that is how I will be doing this one for you. Previously, I had done the whole cost of sales working in uh, as part of your trading account in the comprehensive income statement itself. But in this one, I've shown you another method that you can use. Okay, next, we have the general administration. We start with the balance from the trial balance of 145,000. Then we make the adjustment for the repairs to the roof that is not supposed to be included in there. We remove it, and then we add on the director's emolument 60,000. Depreciation on furniture would be 360 minus 70,000, the 10% of that, and then we take 85% to be 24,650. When we add it up, we'll get 309,650 as our total for general administration expenses. Next, we have the general selling and distribution. The balance brought down for the trial balance 250,000. Freight outwards is the same as carriage outwards, so transport and goods to our customers 65,000. Depreciation on furniture 4,350. This is the other 15% from the that remains from the 29,000. Commission owing 6,000, and we add them down, we'll get 325, 350. Okay, so a question you might be want to ask is why the 6,000 is here. It is an expense, and also it is shown in the balance sheet as owing under the current liabilities. Okay, right. We have the statement of comprehensive income for Audrey Cosmetics. Statement of comprehensive income, proper heading for the year ended 31st of December 2016. The revenue from our workings, the cost of sales from our workings, and we get the gross income, and we take that away from that. Other revenues, the commissions received of 10,000 give us a total income of 1,764,000. Right, less our expenses, general administration 209,650 from our workings, general selling and distribution 325, 350, finance costs 60,000. Total expenses 595,000. And when we take the 1764 and we minus the 595, we will get 1,169,000 as our profit before tax. Okay. We will go to the other slide. The profit before tax is 1,169,000. The tax is 25%. We get 292,250, and we've been out a profit after tax of 876,750. We bring forward the retained earnings on the 1st of January. Notice we must have this section because it's a comprehensive income business. Okay, we'll get 388,000. Retained profit is 1,264,000. We add these two here and we will get 1,264,750, and we pay out the dividend from that of 40,000. Our retained earnings at 31st December would be 1,222,750. Now this is a format and also a way in which you can do your statement of comprehensive income. You can follow it. It's taken from the uh, IFRS for SMEs, and that is what part of your syllabus. If you haven't read that yet, you should go and take a read of it before your exam comes up. Okay, and if you have found this video to be useful, please give it a thumbs up. If you don't find it useful, you can give it a thumbs down. I wouldn't mind. It will give me an indication that I need to improve. And but the key thing is, I would like you to look at it. Okay, so I will see you in the next video.